Hello everyone, welcome back to the Road to Retiring channel. I hope you are doing well. Today I would like to take a look at Enphase Stock. Now this is what my latest video was on 3 months ago, but as you can see on the screen here, Lars left a comment saying great analysis, thanks, looks like this is getting into buying range with current dip. So I thought to return, this would be a great time to start uploading some content again. So I really hope that you enjoy this, and we're going to get into what my valuation is for Enphase now, if things have changed, or if this now is at that buying range. So we're going to reevaluate that today, we're going to revisit it. But first of all, let's take a look at what I valued it 3 months ago. So if we bring up my video here from 3 months ago on Enphase, at the time I said that I wanted to see around a 21% drop in the price before it got to my fair value. And as you can see, my fair value here was around $154.86. Now this was my fair value 3 months ago. Obviously some things may have changed, but it is right around that value right now. As you can see from my tab up here on TradingView, currently trading at $154.33. So close to my fair value. It's just come under, and as you can see, it has dropped off a lot, around 50% since the start of the year. So it could be a potential bargain with how much the S&P 500 has grown in that time. At least in 2023, you can see is absolutely flying. So there's not many bargains on the market at the moment. But Enphase could potentially be one. So let's have a look at the stock's health and some things like that to begin with. Some of the things I like to look at before I go into invest in a stock. Now, what I like to see with any stock I purchase is consistent historical growth rates across a few different metrics. First of these is earnings. As you can see, their earnings, they were in the negatives 2016, 2017, they came out of it, and not only have they grown massively, but they're also projected to continue growing at a really strong rate. And so this is a great sign that I like to see, and that's exactly what I like in the sort of stocks I buy. Now, not only is it earnings, I like to see similar in revenue, equity growth, and operational cash flow. So we're going to have a look at revenue here, and as you can see, it's a very similar picture. It wasn't growing at all really for a few years, but since 2018 the growth has been really strong, way above around the 10% benchmark I like to look for, and you can see the projected future growth is still absolutely flying at a crazy rate. So again, this is exactly the sort of thing I like to see. On top of this, we want to see similar rates of operational cash flow growth, around 10% or higher. And as you can see, since 2016 or 2017, it's up way over 10% each year, up 13, then up 150, then up 700%, then up 50, then 60, then 110. Obviously way above that 10% benchmark I like to see, so that's fantastic. And lastly, equity is the other thing we like to see consistent growth in, and since 2018, obviously it slowed down a tiny bit in 2021, it did drop off, but then it jumped up again 91% the following year in 2022. So really good equity growth for the company. And yeah, so those signs, the historical growth rates are all great, but what else do we like to see? Well, we want to see that the management are investing effectively, and one of the things I like to look at for this is the return on invested capital. Now, as you can see, it's growing at a really nice rate quarter over quarter, which is really nice to see. Currently it's sitting at 26.37%. Now again, I like to see above 10% roughly in this, and that to me is showing really good signs. If we look annually, again, hasn't always been so high. It was in the negatives before they were profitable in 2018, but once since they've been profitable, it's just been great. And yeah, I think the return on invested capital is definitely a big bonus, and it shows that the investment and the management team are making smart decisions with this stock. So that fills me with confidence. And lastly, the thing I like to see is the financial health of the company. If we go to the overview here on TradingView, there's a really good section towards the bottom. You got this financial health section, and what I like to see is that a company can pay off all of their sort of long-term debt and their debt within 3 years of their free cash flow. And if we have a look in 2022, their debt was 1.31 billion, and their free cash flow is around, let's round that up to 700 million. That means they can pay off that debt easily with 3 years of free cash flow. So that tells me that their financial health is in quite a good state. And on top of this, their financial position analysis, well, first of all, them having almost double the amount of long-term liabilities to long-term assets is a little bit of a worry. However, they have so many short-term assets that they can also pay off all of those long-term liabilities if they needed to. So as you see, they're 800 million more in liabilities, but they have 1.4 billion more in short-term assets, so they could pay off all of those long-term liabilities if they needed to with their short-term funds. So right now this isn't a worry, but if this short-term value started to become closer together, and then the long-term, if they couldn't cover the long-term liabilities and the difference between the assets anymore, that's when it would become a bit of a worry. So it's something to keep an eye on, but for now it's okay because of how many short-term assets they have. So in terms of risk rate, in terms of the actual company, it looks okay, but I have accounted for a 15% margin of safety, which I'll show here, and this is because the growth rates expected are so high and they could easily not be met, and so I want a chunkier margin of safety on this in case these ambitious earnings growth rates and revenue growth rates aren't actually met, because as you can see, which I showed earlier, they're super high. The way it's growing from $5 earnings per share in 2023 to $10, that's doubling in a few years, and for revenue, again, doubling in just a few years from 2.7 billion to around 5.2. So when they have such ambitious growth rates, I do like to add on just a little bit of an extra margin of safety just to be safe in case they're not met by a couple of percent. So what else have I put into my valuation? Well, I've gone for a share dilution of 2%, which will take their share count from around the 137 million it is now to 150 million in 2028. I wanted to include a share dilution in my calculation because they have been diluting shares consistently year on year, and they're still doing it now. You can see quarterly it's not going up rapidly, but it is going up slightly from 134 million in Q3 of 2021 to 137 million currently. So the growth rate has slowed down in recent years, but if we look on an annual basis, yes, it's slowed down a lot since like 2019, but on those early years it was growing rapidly. From 62 million in 2016 to 2019 it grew almost double. Now obviously this has slowed down a lot, and I've gone for 2%, which may be a bit high, but we got to make sure we're on the safe side of our predictions so that we're definitely getting these stocks at a bargain price. Now following that, let's have a look at our price to earnings fair value. I've gone for the 5-year estimate here, which is from Yahoo Finance, 18.86%. Now I think that this is reasonable because their realistic growth rate is 29.49%, and this is also lower than the growth rates expected here on TradingView. You can see it's expecting to go from $5.15 in earnings per share up to $10.42 in 2026. Now we've only accounted for an $8.15 return of earnings in 2026, so we've undershot the prediction here by quite a lot, and that might be why, if I show you here, our fair value for price over earnings is a little bit under the current fair value still, or the current market price still, sorry. You can see our fair value is at $128.46, but that's just for the price over earnings. It is different for the price to sales and price to operational cash flow. Now I went for a price over earnings multiple of 21.5 with this, and if you look here, the sector median for the non-GAAP, which is what we included in our calculations, is 19.62, but there is a premium on Enphase usually. You can see there's a 40% difference to the sector, and the 5-year average for Enphase is way above this at around 75. So the price, even though we've gone slightly over the sector median, that's because Enphase is consistently over the sector median. But as you can see, it's at 27.56 now. It is falling over time. This is the price to sales, but if I jump to the price to earnings, you can see this is quite consistently falling. And the price to earnings ratio, it's dropping quite a lot, and I think eventually it will stable out as a premium stock, so still slightly above the sector median, but it won't hold these rates at 45, 60. These rates are just unsustainable. So over time I do think that this will come back towards the sector median, but with a slight premium, and that's why I've gone for 21.5. Now looking at the price to sales fair value, we've gone for a revenue growth rate of 20%. Now this isn't quite taking us to the estimates here, which take you to 5.2 billion in 2026. We're only going to 4.7 billion in 2026, but anything above 20% would just feel a bit too overly ambitious, and I really don't want to go in at a price which isn't a bargain. So for me, I've gone for 20%. This also, you've got to remember, we're calculating up to 2028, whereas this is only calculating up to 2026. So we don't want to use their percentages in case it completely changes the results in the next 2 years. So 20% feels a bit safer to me. And with this $6 price to sales multiple, which I'll go into in a little bit more detail in a second, but this gives us a price to sales fair value much closer to the current price at around $147.58. Now this doesn't mean it's not a good price still, because you can see my 2027 price prediction for both the price to earnings and price to sales is around $237 and $273. So there's still good profit to be made from this $154 current market price, but I just want to make sure I'm getting good returns, and for me that's going to have to come down slightly. Now why I chose a $6 price to sales multiple, I'll show you quickly here. If we skip more towards where the company started to become profitable, once they were profitable, it was trading at around 5.3, 5.4, 5.9, and then started to boom up, and right now it's plateauing back down to where I think will eventually land just above where it begun to completely spring upwards. So I'm feeling around 6 feels quite a safe place. It seems back where it will level out once it was profitable, and that's why I've gone for a 6 price to sales multiple. And lastly, looking at the price to operational cash flow fair value, I've gone for a 21% operational cash flow growth rate. Usually operational cash flow grows slightly higher than earnings because you've got to account for things like depreciation, cash items. There's extra things involved in your operational cash flow than there are in your earnings. As you can see, if I show you here on the operational cash flow, this is made up of your funds from operations, your net income, which is your earnings, is a part of this, but there's much more that goes into it as well, such as a depreciation, non-cash items, changes in working capital, things like this. So usually it will grow at just the same, it will grow at a similar rate to the earnings, but at a slightly increased rate because of the other items. So I've gone for 21%, slightly above that value here of 18.86 in the earnings, which will take our operational cash flow to around 1.9 billion in 2028, which again is about 300 million higher than the 2028 earnings value. That feels about right once you take into account things like depreciation and the other items I mentioned, like non-cash items. So 21% growth, again a slightly premium multiple on it. You can see the current sector is trading at around 20, so it's not too much of a premium, and as it is a stock with a very historic high average, you can see 65.26 is the average over the last 5 years. It has always sort of had that premium on it. I think just above the sector median feels somewhere I feel comfortable, so I've gone for 22 on my price operational cash flow multiple, and my fair value for the price operational cash flow comes in at $152.73, only 1% out from the current market price. So once we take all of these and we average them together, that gives our average fair value a price of $142.92. So only a 7% drop still needed. Obviously this has fallen from 3 months ago, and the reason this has fallen is because some of these analyst estimates have dropped off. You can see 18.86%, even though this is still high. If we look here, analyst 5-year estimate there 3 months ago was 20.05. So because these estimates have fallen slightly, this is why the price has dropped slightly to $142.92 instead of $154, but that's still a predicted 2028 price, I should say, as was changed to 2023 calculations now. But yeah, 2028 price is $264.70, which would be around 11.4% return each year, which would be really, really good. So, and that's even at the current market price. If we get down to this 142 value, it'll probably sit around 13%, which would be amazing. Now, even though it's still 7% out, this is one of the closest of current stocks, because if I show you my metric meters, this is my sheet of stocks that I want to buy. As you can see, my buy value, Enphase is the second closest to the actual buy price that I want to pick stocks up at. So it is at quite a good bargain price right now. The most is WNS, but I do need to revisit this, check that this is still the case, because it's fallen quite a bit recently. And as you can see, 28th June when I valued this, it's now only 1% within that. So if you'd like to see a video on WNS, let me know, and I'm probably going to take a look at it myself soon, but if you want to see a video when I do take a look, let me know. Only 7% out, that is pretty close to where we want to be picking some up. And yeah, I mean, it's at a much better price than a lot of other stocks. As you can see, a lot of the other ones are really overvalued for me. I don't really want to get in at these price levels, but Enphase is only 7% out, so it is pretty close. If you want access to this sheet or my stock valuation sheet that you've seen here, I have got a link to my Patreon in the description where you can download these, and you can subscribe to that for however much you want. I think from minimum of $1, so you can get access to these for pretty cheap. I hope you enjoyed that video going over Enphase and what my new current value for it is. If you did, please do drop the video a like. Let me know in the comments any other videos that you would like to see a video on, or I mean any other stock, sorry, that you would like to see a video on. And yeah, if you enjoyed it, please stick around, subscribe, and I'll catch you in the next one. Bye guys.